What's up guys, and welcome back to the channel. My name is Grant, your local real estate YouTube guy, and today we're going to be talking about the top 10 terms that real estate investors need to know. Stay tuned. Number one is going to be PMI, which stands for Private Mortgage Insurance. PMI is an extra insurance charged to borrowers that have not paid more than 20% on average to their loan. PMI is just insurance for the lenders, to get them a little bit more money in their pocket if you haven't had a large amount of equity within the home, as in you didn't put 20% or more down on the property. And it usually costs between 0.5 to 1% of the total loan amount. So here's an example. If you had a $100,000 loan and your PMI was 1%, then it would be charging you $1,000 per year just for PMI, which comes out to 83.333 repeating dollars per year. And this is a fee that the loan officer or the mortgage company is charging you for absolutely nothing. They're just charging it to you as insurance because you don't have a lot of equity in your property. So that's a key factor and one of the biggest reasons why you'll hear a lot about investors putting 20% down. What is that magic number? Why is it always 20%? Well, a lot of times getting rid of the PMI is the reason for the 20% down. If not, if there was no PMI and it would be the same result no matter what, there would be really no incentive to have to put that much down unless you're really just trying to get a very low mortgage payment. If not, you can just leverage your debt and put as little as possible down. Number two is net operating income, or NOI for short. NOI is the measure of a potential real estate investment property's potential to actually be profitable. It's calculated by estimating the potential property's revenue for the year and then subtracting all of the operating expenses such as repairs, maintenance properties, HOA fees, etc. Anything that does not include the mortgage payment. So you calculate NOI by doing revenue minus all reasonably necessary operating expenses equals NOI. Number three is cap rate, or capitalization rate. Cap rate is used to measure the annual return on a real estate investment based off the amount of profit that the property is expected to generate within that year. Simply put, it's the ratio between the NOI, the net operating income, and the purchase price. So let's say you purchase a property for $150,000 and the first year's NOI, net operating income, is $12,000. You would divide $12,000 by $150,000, which would then give you 0.08, and then that would equate to a cap rate of 8%. Number four is cash flow. We all know cash is king. Cash flow is simply, as it's put, the amount of money you can have in your pocket every month after all expenses are paid. So this is the actual cash amount that you're able to put in your pocket every month or annually. This could be calculated by the amount that you're taking in from your tenants and then subtracting it by the amount that you're paying for all of your expenses like your mortgage, repairs, etc. And that would give you your monthly cash flow. Number five is CapEx, or capital expenditures. This can be defined as the new purchases of any major improvements or renovations that you do to a property, such as things like adding a roof, making an extension to the house, adding more square footage, replacing the HVAC unit, things like that. So these are big ticket items that you need to prepare for in the long run to replace when you're calculating whether a property is a great investment or not. That's something to consider. Before we continue, do me a huge favor and like down below, comment what your favorite term is at the end of the video, if you actually learned something, and just make sure you subscribe for more weekly content like this. If you're interested in real estate, personal finance, things like that, make sure you subscribe and hit that notification bell because I'll be uploading videos like this every week. Number six, 1031 exchange. Whoa, we're about to be talking about some tax loophole that the rich use so they don't have to keep paying taxes. Let's get right into it. So when you sell a property, you're most likely going to have to pay a healthy amount towards the government, towards capital gains taxes, especially when it's a flip or a long-term hold and you've gained that equity. However, under Section 1031 of the U.S. Internal Revenue Code, a taxpayer may defer or pay at a later date capital gains and related federal income tax liability on the exchange of certain types of property. So to put it into very simple terms, that means that you can pay taxes on the income from the sale of your property at a later date if you take that money and put it towards purchasing something that is in equal of value or higher. So practically, if you sell your property, you can run a 1031 exchange, and from there, all you have to do is put those funds into either a equal to value property or greater, and then you can defer your tax payments to a later date. And essentially, you could do this your entire life and never have to pay those capital gains taxes. Number 7, equity. Equity can be defined as the current market value of your property and then the amount that you, the owner, actually owe to your lender. So if you were to sell your property, the equity would be the money left over after all expenses, including your mortgage, was paid. So you'll hear a lot of times, if you, let's say you put 20% down on a $100,000 home, that would be $20,000. You would have 20% of equity within that home. Number 8, IRR, or internal rate of return. Now this right here is a very detailed description on how valuable your investment property really is. This is a common term you'll see when you're browsing rental properties on some type of a crowdfunding website, like people like Grant Cardone, things like that. The IRR is the actual measurement of the property's long-term profitability, which is going to take into account the annual net cash flow and the change in equity over time. So this is not only just going to count your cash flow, but it's going to count the potential appreciation, the decrease in mortgage payments, as in your amortization rate. It's going to take all of this into consideration, and it will give you a true percentage value on how much back your property is going to give you every year and on. Number 9, CMA, or comparative market analysis. As a real estate agent, I'm running CMAs, nearly every day. So let me tell you about it. I know what it is. CMA is going to be a report that's going to show all of the active, pending, and sold listings, and you're going to be running it on a certain property with a certain criteria to try to obtain a potential market analysis of how much that property is going to be worth. So, if you have a real estate agent, you just tell them you want a CMA on a property, and then that will practically let you know how much you could get for the property. Either completely renovated, or it's just your regular home you're looking to sell. That's going to give you a deep analysis comparing it with all of the homes very similar to yours in your local neighborhood. So you can get a value of what you could sell your house for. Very valuable for investors if you're looking at a home to potentially flip. You could ask your agent or do it yourself if you're a licensed realtor and you're just, taking advantage to net that commission on the buy and sell side. You could use the MLS and potentially create a CMA for yourself so you can see how much your property would be worth, all fixed up in top-notch shape. Number 10 is PITI, or PITA, pity. I don't know. PITI stands for Principal, Interest, Taxes, and Insurance. So the monthly payment of most residential mortgages are going to have PITI. So PITI is going to be practically your total mortgage amount and how much you're going to be paying, including all cases, to your mortgage lender. So a quick example, let's say $1,000 per month is going to go towards principal and interest, and we're going to have $40 per month going to homeowners insurance, $200 a month to property taxes, and that's going to give you $1,240 in PITI per month, which will be your total mortgage payment. So that's it for you guys. I hope you liked the video. If you found value in that, please give me a like below, as well as subscribe for more weekly content like this, and I'll see you in the next video.